Welcome to Financial News Daily. There is a number that moved yesterday that most people missed. 40%. That is the current probability markets are pricing for a Federal Reserve rate hike in September. Markets now see around a 40% chance of a 25 basis point rate hike in September, down from nearly 50% a day earlier. CNBC. One day. 10 percentage points. That is not a small move. And the reason it happened tells you something important about the environment we are in right now. Let me walk you through exactly what happened. Because the chain of events from Tuesday morning to Wednesday night is a perfect map of how this market works, and how it will continue to work between now and September 17th. It starts with oil. Gold also drew support from a pullback in oil prices as investors assess the prospects of a deal to reopen the Strait of Hormuz. Escalating rhetoric between the U.S. and Iran amid stalled negotiations further reduced expectations for an imminent agreement. CNBC. Read that twice. Oil pulled back. Not because the conflict ended. Not because the strait reopened. Because there was a rumor of a potential deal. A rumor. Not a deal. Not a ceasefire. A rumor that a deal might be possible. That rumor was enough to move oil. Oil moving was enough to move inflation expectations. Inflation expectations moving was enough to move the September rate hike probability from 50% to 40%. And that move in the rate hike probability was enough to push gold to a 10-week high. This is the chain. Oil inflation fed expectations gold. Every single day. In both directions. The people who understand this chain are not surprised by anything that happened this week. The people who are reading gold headlines without understanding the chain are constantly confused. Here is what I mean. Earlier this year, gold hit $5,589 per ounce. Then it fell to below $4,000. Most people who covered that move said, the war is bad for gold. Gold was supposed to be a safe haven. Why did it fall when the conflict escalated? The answer is in the chain. When the conflict escalated, oil rose. When oil rose, inflation rose. When inflation rose, the Fed faced pressure to hike rates. When rate hike expectations rose, the cost of holding gold, which pays no yield, rose relative to Treasury bonds that were now yielding more. So sophisticated money rotated out of gold and into yield-bearing instruments. The war did not hurt gold. The war's effect on oil and inflation and Fed policy hurt gold. Gold and oil have moved in opposite directions for most of 2026. The connection runs through 3 steps. First, cheaper oil reduces energy-driven inflation. Second, lower inflation reduces the urgency for Federal Reserve rate hikes. Third, when rate hike expectations fall, real yields ease, and gold, which yields nothing, becomes more competitive against treasuries. That is the mechanism. 3 steps. Oil to inflation to real yields to gold. Now apply it forward. Yesterday, inflation data came in at 3.4% for July. 2 consecutive months of easing. The September rate hike probability dropped from 50 to 40% in a single session. Gold rose to a 10-week high. If that trend continues, if August inflation comes in at or below 3.4, the September probability drops further. Maybe toward 30%. And every 10 percentage points that the September probability falls is another leg up for gold. Central banks purchased a quarterly record 289 tons of gold in the second quarter of 2026, a 74% jump year-on-year. They are not buying because of what happens in September. They are buying because of what they believe happens over the next 10 years. The chain they are watching runs longer than 1 month. And that is the question worth sitting with today. Are you positioned for September? Or are you positioned for the next 10 years? Because the chain that moves gold between now and September 17th is one chain. The chain that drives the structural case for gold, government debt above 100% of GDP, persistent inflation above the Fed target, central banks accumulating real assets, is a different chain entirely. And it runs much longer. Everything here is for informational purposes only. This is not financial advice. Please consult a qualified financial advisor before making any investment decisions. One question before you go. The September hike probability just dropped from 50 to 40%. Do you think it keeps dropping, or does August inflation push it back up? Comment below. We do this every week. Stay informed. Stay ahead. Financial News Daily.